So first of all, Professor, I don't want to say your last name wrong. So can you please introduce
Re-
yourself?
uh, Remember my joke? Every time I do this joke and when I get started with the first class and I say, by the end of the semester, if you're not able to pronounce my name perfectly, you are not passing this class. So yeah, maybe I should go back and retroactively do something on your grade in my
Right.
investments class. Huh? My first name is Kemal, which is easy to say or
Right.
easier to say. Last name is Saatcioglu. So it's a long Turkish name, and if you break it into syllables, it's not that bad to say Saatcioglu. It means the son of a watchmaker. Um, so,
Interesting.
but Kemal is just fine.
Do you come from a line of watchmakers?
I've asked this question. There is apparently a watchmaker on my father's side at some point, granddad, but not really.
Right.
Not recently.
Yeah, I would have totally said it wrong. So you
Um,
were, what was that?
there are a couple Turkish letters in the word. The C has this thing underneath it, which
Right.
gives it the CH sound. And then the G has the wiggly thing on top of it, which makes the G silent. So it's tough. It's a tough name.
Right. That's the first lesson. Um, so you were my professor or one of my professors at Rhode Island College while I was studying for my finance degree. And a lot of the stuff that I talk about on my show is stuff that I learned from you. And that was part of the reason why I wanted to get you on, because I wanted to get it straight from the source. But before we start going into markets and financial literacy and all these things, I just want to understand, you come from Turkey. I want to understand how you kind of got into finance, and do you have any experience outside of academia?
Um, yeah, good. uh, it's a good question. I haven't started out uh, being interested in finance. When I was a kid, whenever somebody asked me, I said, "What are you going to be?" I said, "I'm going to be a mechanical engineer," and that was my answer throughout. And I did become one. My undergrad is in mechanical engineering. I and I came to the States. My undergrad is back in Turkey in Istanbul. And I came to the States to actually further study mechanical engineering. I came to Carnegie Mellon University to do my master's in mechanical engineering there. Um, I finished that and then started working as a project engineer in their robotics lab. Um, and we did a bunch of projects. And I realized hey, I know the technical stuff. I can do the technical stuff, no problem. When it comes to doing the business side of things, talking to people, doing marketing, and definitely doing the finances, I have no clue. So after doing that for a while, I worked uh, as a project engineer. I went back to Turkey as well and worked as a project engineer there as well. But then I said, let me get an MBA, so that I know more about the business side of things. So I did my MBA at Texas Tech University. And I took a whole bunch of classes, and just finance clicked with me somehow. I said, hey, engineering is quantitative, finance is quantitative. I like this, and apparently I was good in the finance classes, and the professors also encouraged me to study finance further. So that's how I went into uh, pursuing a PhD in finance, and I did that at UT Austin. And So after that, all my future jobs were in academia, a couple back in Istanbul, Turkey, and then I moved here and continued. I first worked at Bryant a little while, and then moved on to Rhode Island College.
Right. Now that's interesting that you switched from engineering and robotics, which obviously, like you said, quantitative has a lot to do with numbers and that type of thing, but it's a very, very different field. If there's one thing that I know absolutely nothing about, it's that. So it's just interesting that you went over to switch. And it seems like I ask a lot of people this, in the kind of finance business realm. It seems like the people that switch over or get involved in business type areas, it seems like it's just an inkling to learn more about it. It's like, it's not so much that it was a passion. It maybe ended up becoming a passion, but it started off as just wanting to learn more about the business side, so you can essentially do better in your case, engineering.
That's certainly true. That was how I got started with the MBA, and then it turned into, hey, I like this finance area. Let me learn more about it, and then learning more about it turned it into some kind of a passion. I mean, I don't know if I can call it passion, but I still, I have a PhD in finance. I teach finance, I teach investments, I teach fixed income, I teach a whole bunch of finance courses, but I still would say I know a small fraction of what is to be known in finance.
Sure. Now, what's interesting about finance as a whole, especially when you start getting into investments and stuff like that, it's kind of hard to pinpoint certain things. Like there's no real hard and fast rules. Like there's a couple, portfolio theory, certain things when IPOs, become accessible, the price rises, these type of things you kind of predict. But people always ask me, should I invest in this or should I look into this? And it's like, you can, sure, by all means, it's hard to give like a pinpoint advice when it comes to investing, I think.
Absolutely right. When my advisees come into the office to talk about things, many of them ask, hey, I want to get started in investing. What should I invest in? And or in class, the discussion goes there. And I really don't have, I don't want to be responsible in saying, hey, invest in this, even if I have a strong opinion in something.
Sure.
And usually I don't. You're absolutely right. There are some rules, and I wanted to listen to your Finance 101 before coming on. So I did that, and you mentioned some of those things there. Start early is one of the main things. Start
Right.
investing as early as possible, because doesn't matter how much you start with. It matters when you start. Of course, the more money you have and the more you can invest, it's going to make a bigger impact when you have even modest returns. But if you wait for that, you may never get there. So for most of us, it would be better to start as early as possible with whatever you can afford. Start with $100 and start investing, and it will slowly grow. And as long as you can add to it over time, it's going to become something meaningful. So start early, and don't put everything in one thing. You hear about these big returns in this and that. Don't throw all your money in there. It's so diversify and put in different things. I listened to a bunch of your podcasts to get an idea as to what we can talk about. And you mentioned the S&P 500 ETF and other ETFs. So that's my standard advice as well. If someone is getting started, put your money in a broad market in ETF, and the broad market is either S&P 500, Nasdaq, and if you want to make some bets, you can make bets in a certain sector, a certain group of stocks. But again, don't necessarily, especially if you have very limited funds, don't put it in one stock. Like, hey, I heard of GameStop. It is going crazy. Let me put all my money, which is $400 in buying one GameStop stock. I mean, it goes down to 150 and you lost a whole chunk of your investment.
Sure. Now, I'm happy you brought that up because obviously that was something very recent. It kind of made the market go a little crazy. And now, don't get me wrong, I'm all for the average Joe getting the big up on the hedge funds and the corporations. I'm all for that. But I don't know if people understand the damage that something like that can do to the market for a certain period of time. I don't know if people understand that there's kind of an influx of information. And when that happens, it can cause some unnatural movements in certain sectors of the market.
Absolutely. We watched this happen in real time in our investments class last semester. And if you think of it as the little guys getting together and showing it to the hedge funds, it even sounds like something noble or attractive. And
right.
But anytime you have these kinds of movements, it makes things unfair to some people. And I'm not talking about hedge funds. I mean, at the end of the day, some of these hedge funds took hits, but I think they adapted quickly. And towards the end, and now, I don't think they are suffering because of this.
Right.
But because of all these large price movements, again, it ends up being the average person who's going to suffer most from this. Hey, I hear the hype about GameStop. Let me put money in it, and then it goes down to half, and then I realize, hey, I don't know much about these things. I shouldn't risk my putting money in these things, and there goes my whole investment life.
Sure.
If it causes people to look at the market and say, hey, this is not an investment opportunity, or this is not this is just same as going to a casino and betting. It will keep a lot of people from entering the investment area, and that's a big harm that I see in these kinds of things.
Right. Yeah, I think what's happening is some people are, and I'm sure this has happened, periodically over time, but there's a lot of trend investing, and it's coming from a place that doesn't acknowledge the fundamentals, doesn't really acknowledge the technical factors and the news, right? The news is keeping up on current events. A lot of people aren't doing that. They're just, oh, what's that, GameStop? What's the other one? Bath and Body went crazy. A couple of them. You can even say
AMC.
some of the AMC. Yeah, exactly. You can even say some of the cryptos, that thing. And people are just kind of going in because everybody else is.
Look, finance and valuation, if you get into it as at a professional, how it's done in professionally, it's difficult. I mean, one of the most difficult things you can do in finance is to value a company. I mean, right. When a company is taken public, the IPO process, these investment banks are hired and paid millions of dollars to go through a due diligence process and to come up with a value for the company so that they can determine a share price to sell it to the public. We learn, or we teach the way to value a company is very straightforward. We teach it even in our introductory finance course, and definitely in investments. The process is, okay, forecast the cash flows, discount them back to today at some discount rate, and bingo, you have a value. But how you forecast those cash flows, how far you go in the future, how optimistic or pessimistic you are about the business of this company. I mean, analysts come up and say, hey, a value of Tesla, what's it trading these days? 700 something. One analyst could come out, and these are all credible people doing this for a business. They are making money off of this. One could come out and say, hey, the true value of Tesla is just $300. So it's highly overvalued. Another could come out and say it's actually $3,000 and it's highly undervalued. So how can one person say it's 300 and another say 3,000? It looks like they don't know their shit, but they do. They go through a process. But everything is based on assumptions in these cases. And for a company like Tesla, you can be very optimistic about the future businesses, and you can put insane cash values for the future and discount them back to today and get to 3,000. You can be less optimistic about it, and then you can come up with a very much more modest number for it. So coming up with a value for a company is really difficult. So, making bets on certain companies, sometimes they work. I mean, the guy who bought GameStop at 10 and could sell it at 400 made a ton of money and great. But that doesn't happen very often. That to my knowledge, something like GameStop's case happened once in a lifetime. It's so if you're new to this, if you're getting into this, if you have a limited amount of funds to invest, as far as I'm concerned, the best thing to do is, hey, buy some ETFs, buy some broad market-based ETFs, put your money in S&P 500, put your money in NASDAQ if you're more technology oriented. If you believe economy will pick up and small stocks will, smaller businesses will benefit from this more, invest in a Russell 2000 ETF. It's the small market cap index. All of these, I mean, if you look at the past 1 year return on any of these, yeah, sure. If you invested in Tesla, your money is now tenfold. If you invested in GameStop, your money is 40-fold, or something like that. Well, it was 40-fold at some point.
Right.
Now it's 18-fold. But even with these kinds of broad market indexes and ETFs, where you really aren't taking a whole lot of risk, they're up 40%, 50%, 60% in the past year because the market has done extremely well. And that's another thing to talk about. I mean, why did the market do so well when everybody has suffered from the pandemic, and you go out and talk to any business, they're struggling, and then why is the stock market doing so phenomenally well? That's another thing. But my point is, you don't really have to take extreme risks to participate in the financial markets gains. You can go with ETFs, and that would be the sane thing to do as far as I'm concerned at the moment.
Right. That's pretty much what I tell people. If anyone asks me, hey, I'm looking into this, I'm looking into that, I'm like, listen, if you want to invest, first thing I would do, and I have done, is, and I tell everyone to do it, is find an S&P ETF that you like and start off with that. And then, like you said, if you want to make some bets here and there, then it's different. And then you start to build your portfolio. Now, a question I had was, it seems like the consensus for most institutional investors, and even a lot of individual investors, portfolio is the way to go. Build a portfolio, grow it over time. You'll get some kind of return. It'll grow exponentially. But then there's an argument that the market's going to do what it wants. Where does that kind of stem from? Because I know that there's counter arguments to the portfolio theory.
It comes back to there is this whole argument that there used to be, when I took classes for my PhD degree, there were a whole lot of articles written on market efficiency. So there was a lot of discussion and talk about whether markets are efficient in pricing or not. And that means different things to different people. But based on that, there is the argument as to whether you should try to beat the market, do better than the market, or should just aim to do just as well as the market. So if you believe that markets are generally efficient, then you should invest passively, which means buy some ETFs, broad market-based ETFs, and just hold that. If you think you can do better than the market, which sort of means markets are not all that efficient, there are mispricings in the market, there are opportunities for you to make more money, and those are things like, hey, I can spot Tesla when it's about to take off, or I can find the next GameStop or something like that.
Sure. Then
it might make more sense to create a portfolio of your own and put them together and hold on to that. So if you're asking me where I am on this, the starting point should be the passive investing. The starting point should be putting your money in the ETFs. Right. And then as you can spare more and you can have some portion of capital which you would not be crying over if you lost some of it, then you can also start adding to it and creating your own portfolio and selecting stocks individually. Also, it will depend on how much time you're willing to invest in this. I mean, right. You can't really listen to news stories about two different stocks or go on Mad Money once in a while and pick up two stock tips and use that. If you look at the names of the stocks that are given as stock tips on something like Mad Money, for example, not all of them pay. I mean, you'd need to invest in enough of them to make an overall good overall return. And to be able to invest in a lot of them, you need a lot of capital to start with. So assuming you have limited funds, that diversification is much better created by buying some stock market portfolio. I mean, that portfolio is created for you when you're buying an ETF.
Sure.
And also, let's make sure that everybody understands this is also, even that is not risk-free. I mean, it's not like you put $100 in there and the $100 will stay 100 or grow more. I mean, the market, it can tumble tomorrow. I mean,
Right.
the exciting thing about financial markets is that you don't know what it's going to do tomorrow. If we knew what it was going to do tomorrow, it would do it today, because then everybody would know it, everybody would act on it immediately, and it would get there tomorrow. If today something's price is 100 and everybody knows tomorrow it's going to go to, or 1 month down the road it's going to go to 150, what do? We'll all buy it today. And
Sure.
as we are all buying it today, its price will increase because immediately there are a lot of buyers and not enough sellers, and then it will go to that 150 very quickly. Yeah, it's
That's sort of what happened with the GameStop and the AMC. People just bought, held. Very similar to, like the what's it, pump and dump type thing. That is technically illegal, but if I guess a big enough group does it, then there's only so much you can do to stop it from happening. But I think one of the biggest things, especially for young investors, is putting, working on your portfolio, keeping up on the current news, but ultimately almost forgetting about it, letting it kind of build, do its thing, pay attention to it, maybe once a day, give it a look. You want to buy this, sell this, do your research, all these things. But I know so many people that go crazy every day. They're looking 2, 3, 4, 5 times a day, and they just get discouraged because they were told, or they were under the assumption that this stock or this security was going to get me here in this amount of time. And they get anxious and they sell, and they're not in the market anymore. And I think it's unfortunate, because there's plenty of ways to, just as we've been talking about so far, there's plenty of ways to do it. Plenty of ways to get involved in the market in a way that matches your risk tolerance.
There's been research on this. Like people have looked at mutual funds, and mutual funds have professional money managers who do this for a living, who their salary is dependent on how much money they make and so on, or for their investors. So there are a bunch of studies that look at these, and one I remember is they look at how mutual funds managers have done with respect to the market. So have they done better than the market or worse than the market? So those that have done better than the market in one quarter or in 1 year, how did they do next year? Have they done better than the market or worse than the market? And when you look at them sequentially, it's very rare that a mutual fund manager or a mutual fund for that has done better than the market, say 5 years in a row. So does better than the market in 1 year, worse than the market in the next year, better than the market in the next year. So one that does better than the market 5 years in a row, it's so rare, it's almost impossible to find.
Sure.
So if it's that difficult for a mutual fund manager whose job is to do this, who has a number of analysts working for him or her, giving all these recommendations about stocks, what is undervalued, what is overvalued. If it's so difficult for them to beat the market consistently year over year, how am I going to be able to do that year over year? I can get lucky and beat the market one year. I may have seen Tesla would do well. I may have seen cryptocurrencies would do well and have invested in them and done phenomenally well this year. That is not a guarantee that I'll be able to see the next trend and find that. That all comes back to how much time and effort do I want to spend in this?
Right.
And the best way to do this, I completely agree with you, is to if you can put your money in there and pretty much forget about it, it's and over any long run you look at it, it makes money for you. That seems to me like the best deal.
Right. And it's interesting that you bring up how hard it is to actually beat the market for a long period of time. When you were mentioning that, there were two names off the top of my head that I immediately thought of, and that's Warren Buffett and Edward Thorpe. And both of those guys are notorious for doing those things. And then when you learn about what they do and how genius they are, essentially, then you almost humble yourself and you're like, okay, this is a long game, first of all. And second, these two guys are like the legit best at this. So I got to understand where I'm at.
Exactly. Warren Buffett is the classic example. And one of the things he recommends is, hey, invest in stocks, invest in stocks that you invest in companies that you use their products or services. So if you let's say buy a lot from Amazon and see everybody buying from Amazon, okay, buy some Amazon stock. If you see the trend that you've started riding on Uber a lot and you see everybody doing that, buy that stock.
Right.
Don't go and put your money into some obscure name because you've heard the name as a potential good opportunity on some talk show or somewhere.
Right.
Somebody told you that they heard from the friend of a friend that, hey, XYZ is going to do phenomenal. And you say, hey, let me not miss this and put money in this. Well, you may get lucky, but you may not. And odds are there are so many players in the market. There are so many people in the market that if you look at this probabilistically, if you look at how many times you can get lucky, it's not much. It's
Sure.
not favors are not in your corner.
Right. Yeah. And that's the thing that kind of differentiates, investing and trading, because trading is almost, unless you're a day trader or you're learning to be one, you're using a program or whatever. That's one thing. That's obviously one way of doing it. It seems like a very stressful way to do it, but that's kind of where the difference is. It's the investment horizon that you're willing to wait. But to me, it seems like trading, although there are techniques and ways to do it, it's a lot more risky, and it's closer to me as, or it more closely resembles to me a casino or the betting. Or I remember sitting in your investments class and we were talking about options. for the first time. And the way you actually describe them to us is you're putting a bet on a company, in not so certain terms, but you're essentially putting a bet on a company. And I remember hearing that and I'm like, wow, that's really weird, because I always thought there was this weird separation between, working in the market and going to a casino. Because everybody says, don't go to a casino. You're going to get, the gambling and all this stuff. But more people are involved in the market. People have 401ks, all these type of things. But it's interesting how depending on your horizon and your techniques, you could just be playing in a casino, playing slots.
And don't even get me started on options, because
Right.
there is a whole different level of betting involved when you're dealing with options, because options have expirations.
Sure.
I mean,
you got to get the price and the time right.
You've got to get the price right, and then you have to make your bet so that your timing is right. So you buy a 1 month call option on XYZ. If it goes up within that month, you make money. If it doesn't, it stays there. Doesn't matter if it goes tenfold next month. You've lost everything.
Right.
It's sort of a huge. It's like a roulette wheel bet when you're dealing with options.
Right.
There are methods of using options as risk management tools, but they're not for the average person. And one of the risks that we're seeing with the Robinhood kind of platforms is too many people who know pretty much nothing about the risks involved can very easily get access to these instruments, and we hear about the instances where people have made phenomenally well, which attracts even more attention. But the people who lose their shirt, you can imagine they're not as willing to come forward and brag about it, right? So, but there are a lot of those folks out there as well.
Yeah, Robinhood was an interesting thing because they, like you said, they're giving. I think it's a good thing. Oh, what's happening here? Oh no, we're good. I think it's a good thing that it brought, quote unquote, everyday people who are nervous to invest. I think that's cool. It brought those people to the table, but in doing that, it added a lot of uneducated or I guess we could say ignorant noise to the market. Also, the fact that you can get things like options, you can get these more or less advanced securities on a platform where people are beginners for the most part. So, and then the whole thing goes down where they can't pay out. They stop people from trading these certain things because everybody went overboard. So I think Robinhood was an interesting thing because I use Fidelity. And there was a point where I wanted to start a margin account. This is when I was a little younger, but I wanted to start a margin account. I wanted to do the options and all this stuff. And there's so many like ladders, or I should say, there's so many hoops to jump through on a platform like that. But then you have something like Robinhood where everybody, you can just go and do your thing.
Many of those established platforms, they seem like they're very restrictive, and then sometimes they are, but sometimes that's for good reason. That's so that less people come and treat this as a casino.
I think last year, and you kind of spoke about this earlier on, and we can just circle right back to it. I think last year everybody got a lot of free money, and that contributed to to the market doing so well. Everyone had a lot of free money, a lot of free time, and it almost seemed like the trend was to go ahead and start putting money in the market. It was almost like overnight. My friends who had never invested, or some people who I'd known that were nervous about it, now they're all in because they have all this money that's coming in, and more money than a lot of people that knew what to do with, essentially. And I agree with them. I think that they should totally put their money in. But due to the influx of it, it sort of created I don't want to say a bubble, but an inflated market. Because once things started to correct themselves, maybe, I don't know, a few months ago, and people were like, oh no, people were pulling their money out. People were nervous. They didn't know what to do in a time like that. So I think it's an interesting thing that because people were seeing so much extra money, the market was doing so much better.
If you look at financial markets, financial markets is a very broad term. If you look at equity markets, if you look at stocks, over any long-term period, they've done really well. So if you look at an investment horizon of 10 or more years, if you are able to hold on to your investments 10 or more years, you'll do well. At least history tells us that. You'll do better than if you were to put your money in other things like gold, or if you were to put your money in real estate, or stock market over a period of 10 or more years have done better than other alternative investments. But it is very risky if you need the money at some point. If you are thinking, hey, let me I have $50,000 and I'm planning on using that for a down payment on a house next year. Let me put the $50,000 in the market. Market may go down 30-40% in a year. It has done that at some points in time. It doesn't happen often, but it can. And if it happens to be next year and your 50,000 is down to 30, that means you're buying less of a house because of this, when you need the money next year. If you can hold on to the investment 5 more years, it will probably recover and you'll get to a better place. But you need to have that flexibility. So that's why starting early helps. If you start early and you're able to put $500 and forget about it for a year, it'll maybe become 600. If you can forget about it for 10 years, and each year maybe you put another couple hundred, 300, 400, 500, and as you start making more money, you can put more money in there. It's going to become a substantial amount at some point, and you can use that for something. So you also need to sort of think of where you're headed. What's your goal? If the goal is to have more money than you have now, there is no end to it. Sure. If the goal is to enjoy your life and say, take that vacation or buy that house or do this or that, then there is a goal, and then you can achieve that goal through investment. If the goal is to have ever increasing amounts, there's no end point.
Sure. Again, it's all about investment horizon. Another thing I wanted to bring up, which isn't spoken about a whole lot as of recent, but I feel like it's a problem. I don't know. This is what you're here for. So interest rates have been incredibly low. for a little while. They've been incredibly low, and the Fed suggests that they're not going to do anything about it until, I think it said 2022. I think next year they might raise rates or change them or whatever. Now, this is really interesting to me because interest rates are low, but the market is doing very well, which is typically what happens. Rates go up, people want to go buy bonds, the market's a little less attractive. But what's happening is a lot of that free money, a lot of these stimulus packages and stuff like that, it seems to be devaluing the dollar. But there's no real inflation going on. And to me, I want to know what exactly is happening, or what could be happening, I should say, and what kind of detriment is it going to cause later on? Because I understand when the Fed wants to lower rates, it's usually because they want to jumpstart the economy. They want to get some more money flowing through. And I can see why they would want to after a year we just had. But it's just strange to me that there's all this money going out. Inflation hasn't changed. People don't seem to be worried about this kind of thing.
First of all, what purpose does the interest rate serve? The first thing to understand is interest rate isn't something that somebody says, hey, it should be 3% and everybody agrees on it instantly. It's somebody doesn't set the interest rate. The Fed has some guidance, gives the market some guidance in that. But eventually, the interest rates are determined by the market in terms of how much you're willing to pay for borrowing money.
Right.
When interest rates are really low, it makes borrowing easy for all of us. It makes it easy for me to go get a mortgage and buy a house, or makes it more attractive for me to do it than otherwise, because hey, I'm going to pay 3% rather than 5% interest. And if it's a $100,000 loan, 3% is $3,000, 5% is $5,000. If it's $1 million loan, it's $30,000 versus $50,000. Paying $50,000 interest is much more difficult than $30,000 interest. So there is that part. Then for corporations, the same thing. If interest rates are really low, they can go and borrow from the bank or sell bonds, and then use those funds to grow. And the threshold they need to beat to make money is very low, because if they borrow at 3%, if they borrow at 5%, they need to make sure they make more than 3%, more than 5%.
Right.
If they were borrowing at 10%, they would need to beat 10% to make money on that. So the lower the interest rates are, the more inclined we as individuals are to borrow more, and same goes for corporations. It also helps, and this becomes a bit technical, but the way we value companies, you forecast cash flows into the future, and then you bring those cash flows to today by discounting them at some discount rate. That discount rate is based on the riskiness of the company, but there's always a base level, which is the base interest rate in the economy. So if that is low, then the discount rate for every company is lower than what it could be. If interest rates are increasing, the discount rate for every company is increasing.
Right.
Regardless of the risk level. As the discount rate increases, the valuations go down. As the discount rate goes down, because you're dividing by a smaller number, the valuations go up. Right. So lower interest rates boost the stock market because companies can borrow and grow faster, and then their cash flows are discounted at a smaller discount rate. So in that kind of a setting where interest rates are really low, a lot of money goes into the stock market because stock market returns are expected to be really high. And on top of all this, why would you go and put your money in a CD or in a bank account when that will return you a meager 1%, if that?
Maybe, right? Yeah.
One of the suggestions given to new investors is, well, while you're diversifying, also diversify between stocks and bonds, equity and fixed income. So if you are, for an average portfolio, people say, hey, do a 60-40 split, put 60% in stock market, in the stocks, and 40 in fixed income. That's if you are sort of middle-aged. If you're younger, do 90 or 100% in the equity market. As you get older, you can switch more into fixed income and leave less into the stock market. If you're 2 years from retirement, maybe put 80% in fixed income and 20 in the equity. So because fixed income is fixed and there's less risk in there, and there's much more risk in the stock market. But the longer your time horizon is, the more time you have to recoup things if things go wrong. So put more in the stock market. So what I'm trying to tie this to is, in the past, even though interest rates were relatively low, they were still headed lower. I mean, 5% was low, but 4 is lower, and then 3 is lower, and then 2 is lower. So they were headed down. When interest rates go down, if you have bought bonds, you also make money on the capital that you've invested, because when you buy a bond that pays you 3% interest, you buy $100 worth of those bonds and you get only $3 interest. But when interest rates go down to, say, 2%, your $100 is more than $100. When you sell the bond, you get more than $100 because this bond is more valuable, paying 3% when everybody else is getting 2% in the economy.
Sure.
So as interest rates were going down, there were incentives to still buy bonds. Now that it seems like we've bottomed out and interest rates are going up, at this point, it's very difficult to attract capital to bonds, to fixed income. If you know interest rates are going to go up, why would you buy bonds at 1.5% when you think they'll go up to 2, 3, 4% in 2-3 years? You lose on your capital as well when interest rates increase and you have a long-term investment tying you to receive a very small percentage. So that has altered this shift between stock and bonds. It makes less sense at the moment to put money in bonds than ever. So all of those funds are also coming to the stock market, making it go even higher. And that's one explanation as to why the stock market has done so phenomenally well over the past year. Money had nowhere else to go, and there were a lot of people who got money that they weren't expecting. So there was a check that came from the government. I had my budget made up so that I wasn't counting on this. I have $5,000 extra now. Let me put it in this. Where should I put it? Well, the stock market. It seems to be doing so well. So that also contributes to this increase, or contributed to this increase. But where all this is heading, I think inflation will be definitely higher than it has been. How much higher? I don't know, but it's definitely going to be higher.
Right.
I mean, the current administration's infrastructure plan, for example, if they can go through with it, I mean, I think it'll be good for the U.S., but and it will create jobs, and it will revamp things that needs to be redone.
Right.
But all of that means there's going to be more money in the economy. More money means more buying power. More buying power means, unless supply suddenly shifts, prices will increase, and prices will increase means inflation. So all of that will contribute to higher interest rates over the coming years.
That's one of the things I think people forget about. Inflation, or two of the things I should say, inflation and interest rates. Those are a couple things that when people are trying to navigate their money and put it in the right spots, they almost forget about those two things. Because let's say on average, I'm sort of making up numbers here, but let's say on average inflation is 3%. So that means every year, you're losing 3% of your, you're paying 3% more for things. So if you're on your investments, if you're not making over 3%, you're kind of not doing much. You're just kind of staying in that. That's why I try to advise people to start to move away from the conventional bank account. Don't get me wrong. Very important. You need to have cash reserves. You need to be able to pay your bills. You need a bank account for plenty of reasons. But the more money you hold in there, you're losing it, because every time the inflation and the interest rates change, in the upward fashion, you're losing money or missing out.
And so far, in the past 5 to 10 years, inflation has been a non-issue for the US. So people sort of rightfully forgot about inflation. If it's 2%, well, yeah, I mean, you're losing 2%, but as long as your investment makes 2.5%, 3%, you're still better off than you were last year.
Right.
But if you look further back, in the US, there have been periods where inflation was 7, 8, 10, 12%. And I always give this example in my classes. I mean, I'm from Turkey. Turkey has notoriously been known for high inflation rates. And all through my childhood and even through college, we had inflation rates around 60 to 80%. 60 to 80%. That's
Wow.
1 year's inflation. We had inflation that went up to 100, 120% per year for a period of time. 100% inflation, think about it, what that means. Something that costs $100 today, 100% inflation means next year it'll cost $200. So it's a different kind of economy. I mean, right. I'm not seeing anything like that for the US. I'm not saying anything like that will happen. But I mean, there are countries where inflation has been 40, 50, 60% for prolonged time periods, and is a different ballgame.
Right.
I can clearly see inflation going up to 3, 4, even 5% over the next few years. I don't think it's going to stay that high for a long period of time. But the thing about the Fed saying we're not going to increase interest rates is, hey, we want you to be able to spend the money you get, because if interest rates are higher, then you have more incentive to put it in fixed income and not spend it. And also, if interest rates are high, corporations are less likely to borrow and do grow with it. But the risk of that is, if the economy heats up, if there's too much activity in the economy, too much buying, then inflation is going to go up to a point where the tool to control inflation is to raise interest rates. It's counterintuitive at first, but when you raise the interest rates, then marginally less people will borrow, and marginally less corporations will borrow. There'll be less activity in the economy, right. And less activity means less buying, and less buying will put a damper on the prices rising. So
gotcha.
Even though it seems like, hey, inflation means sort of causing higher rates. Why are you pushing rates higher? Well, I'm pushing rates higher so that not everyone borrows as much as they are, or some people stop borrowing, or some corporations stop borrowing and doing buying more things with those funds, so that prices do not go as high or as fast.
Right. So low interest rates would act almost as a catalyst for maybe a struggling economy.
Yes. That's why in recessions, you see interest rates going down. Right. So like in the 2008, 2009 financial crisis, one of the things the Fed did was to go down to almost 0%.
Right.
And if the economy isn't growing, if the economy is in a recession, then interest rates are taken down so that it's almost free to borrow to do more activity in the economy.
Right. Another thing I wanted to talk to you about, and it's kind of in the same realm of the trend investing that we were speaking about, is this, it's fairly new, few years it's been going on, I guess. For lack of a better term, crypto boom, the cryptocurrencies that we know we have a limited amount of information about in terms of where they come from and how they're created. But for whatever reason, they are very, very hot commodities at the moment. And I say commodities because that's how they act. They don't really act as currencies. You can't buy much with them. But nonetheless, for whatever reason, people are very, very interested in these things. And I'm interested in your opinion, because a lot of people are saying, as we just got done talking about inflation and the devaluing of the dollar and stuff like that, people think that this is an opportunity for these cryptos to kind of peek out from behind the curtain and start doing some different things, making some adjustments so that they actually do act like the currency of the future that everybody thinks that they're going to become. Now, me personally, I have a select amount of, a select surplus of information when it comes to cryptos. And I'm still skeptical. I think people should be skeptical whenever people are running towards something. I think everybody should be somewhat skeptical about it. So I guess what is your kind of take on cryptocurrencies, maybe the future of them and the current market that it's in now, or that they're in now, I should
say. I knew this question was coming, or this topic was coming. So this is one area where I'll freely say I don't know enough about it to tell you something, because one of the things that I try to be careful is, since I teach finance, whenever I say something about finance, it's whoever I'm talking to, it's easy to take that as a known fact or the consensus. So whatever I say about cryptos, cryptocurrencies, Bitcoin, and the firms that mine it or use it, it's on very limited information. I haven't done the research to know enough about them. So there is more opinion here than fact in what I'm saying about them. And I take the same point of view as you are taking, that they are, at the moment, very risky.
Right.
What you think about them depends on what you think will happen with them. So if you think that cryptos are the currency of the future and that a lot of things will be bought and sold using cryptocurrencies, and it will have a regular market where you can use it as cash or maybe in place of cash, then all of that would mean a very optimistic view and higher values for crypto. I don't really know where to be on that scale. And I know this is an unsatisfactory answer to the question, but that's where I am. I don't know where to be on that spectrum. I see a lot of problems. I see a lot of issues like, well, one of the selling points is not being regulated by some outside body, some government, some agency. Well, that also brings the question about fraud and how easily things can be stolen or I don't know if even faked. And then there is also the notion that there are now articles coming out saying is crypto then replacing gold, for example. Mm-hmm. Well, part of the deal with gold is it has value because it has a limited amount. We have a limited amount of gold. There are uses of gold as well. And then for a long time, gold has backed currency, and countries had to keep an amount of gold to back their currency reserves. So there was some fixed demand for it, and then also there was limited supply, limited quantity, and therefore some value associated with gold because of that. Now the same thing is said for cryptocurrencies, that all of these algorithms that are used to mine crypto, there is some bound to how much there will be in any of these, say Bitcoin, for example. There is a max to it.
Right.
I don't know how that's enforced. I mean, I'm not knowledgeable enough about how those algorithms work. A good person to talk to for this would be another of your professors, Murat. He does a lot with data science, so I'm sure he'd know more about this than I do. But it's one area I'm staying away from.
Touchy area, yeah. No, I completely I agree with the fact that we have very limited information on it. And I think that's the biggest worry because, you know, I'm sitting here with a finance professor and it's, it's tough to even pinpoint where these things are even coming from, where these currencies are. So I think that enough should be sort of a red flag. Now, don't get me wrong. There's people who've made a ton of money on it, and I'm not opposed to people making money. I think everyone should go and do their thing. But again, it's just the trend investing is what's worrying to me. Is it's the people who are just kind of going after it, and who knows? They could boom or they could bust. But it seems to me like the information is just too scarce to make a real educated decision on it.
I mean, one doomsday scenario is, for example, if countries collectively come together and say, "Hey, this is too risky, and we're all banning the use of cryptocurrencies in transactions."
Sure.
What value do you have for cryptocurrency at that point? I mean, that's basically drops their value down to zero.
Right.
On the other hand, there could be some regulated environments where it's used for transactions, and friends and colleagues who know more about it tell me there is actually more to it than just the currency. It's the blockchain thing that you are able to see the transaction progressing through as through the supply chain of production. So there could be some valid use, and if it becomes mainstream, there's going to be some value. I don't know if the value will be comparable to gold. I don't know if the value will be as high as it is now, or again, it's one area where there are insane valuations. Some come out and say it's 60,000 now. Well, it was 2,000-3,000 at some point that I know, so it wasn't that far back, so whenever I see that kind of a price increase, I'm hesitant. But then people come out and say, hey, it could go to an insanely large amount. I mean, 60,000
Sure.
now could go to $1 million.
Sure.
Depends on all your future predictions, and if we knew what would happen and came back, we'd all be rich.
Right. And that's the super interesting thing about finance as a whole. It's almost like, one side has a view, the other side has a view. There's people in the middle, and you kind of just have to, a lot of this is just thinking that, being optimistic or being pessimistic. And it's funny that you brought up blockchain, because when the crypto thing happened the first time, when Bitcoin hit whatever it hit a few years ago, everyone was telling the real thing was like, oh, Bitcoin's cool, but you got to invest in the blockchain. And it's funny because I got a little war story about it, because when I was in college, which was what, 2 years ago, something like that. I bought Riot blockchain, which is like the big one. And it was at $8 a share. And because I was so nervous about it and whatever else, I sold it. I may have made, a couple bucks or something on it. And now it's at $40 a share. And I look at it all the time.
It was as high as 67, I think, at some point
Right.
in the last couple months. So, I mean, yeah. If you bought it at 8 and it becomes 40, 50, 60,
yeah,
you've done outstanding. But how many of those will you be able to to find. And
Time
then
out. Yeah.
also, how many of those will you say you heard of Riot when it was 60 and you bought a bunch and now it's 40? Well, you've lost like 25%, 30% of your investment. So
Sure.
I even in investing, I think the best rule is to have a solid investment purse and also maybe have some play money.
Sure.
So and this all depends on your budget. If you have $1,000, maybe put 750 in some market investments, buy S&P 500 ETFs, and with 250 you can try to find these gems to speculate. Exactly. And even if you lose a whole bunch of it, it's not going to wipe you out. It's not going to break you. Exactly. And if you do really well, then it adds to your portfolio, to your overall wealth.
One more thing I got to ask you before we wrap this thing up. One of the last classes I had with you was fixed income analysis. And this question has nothing to do with that. But at the time you were working on either level 1 or level 2 of the CFA tests. I forget how many of them there are, but have you made some progress in that? Are you still working on that at all?
Was I studying for them, taking them, or what was the deal with them? So CFA has 3 levels. CFA Institute has 3 levels of tests. There's level 1, level 2, and level 3. And I started going through that after I started at RIC, and I took the exams 3 years in a row, and I passed level 1, level 2, and level 3 in 3 years. And then when you do that, you get the CFA Institute charter. You become a chartered financial analyst. So I'm not sure if you're talking about that or the fact that we were also, I am CFA chartered, as well as one other professor, Professor Kazemi at RIC. And because we have this link to the CFA Institute, we're able to use their curriculum in some of our classes, and fixed income was one of those. So we were using the CFA Institute level 1 fixed income material in our fixed income classes. And that way, anyone who went through that class also got ready for the fixed income portion of the level 1 exam. So
maybe
that might be what you're referring to.
Yeah, maybe I'm conflating details, but so I didn't know that you had. Maybe I did know that you had completed it. I don't know. For some reason, I feel like you were telling us that you were working on one. It might have been the last one.
It might be that I was working on especially if this was a spring course. Then what I basically did, I generally don't have time to do these kinds of things during the academic year. So once classes end in May, each of the 3 levels, and I don't recommend anyone to do this, but I took off 3 to 4 weeks and crammed for the exam in those 3 to 4 weeks, and the exams were generally in June, and I took the exams in June, but did pretty much nothing but study for the exams for those 3 to 4 weeks, and literally, I mean, get up at 6 a.m. and work through the day till 8 p.m. and go to sleep and get up and do the same thing over. I may have told you guys in the class that, hey, once this class ends, I'm going to start doing this for level 2 or level 3, wherever I was in the process. That might be the case, but I'm happily done with that.
Right. Well, there you go, people. Never stop learning, right? You're a professor, and you're still doing, still trying to learn more, still hungry for knowledge. So
yeah, I'm curious about learning more about cryptocurrencies. Currently, I'm working on a couple papers looking into ESG factors, environmental, social, and governance factors. So, and I'll do this as long as it inspires me. It makes me interested in learning more things. Once it's no longer fun to do, there's no reason to do it.
Sure.
So that's my philosophy in life. Do things that you like. And that doesn't matter. I mean, of course, you have to make a living, and then you have to live a decent life. But there are always greener pastures out there. But you have to like what you do. Otherwise, it's not worth doing.
Right. I totally agree. Well, thank you, Professor. Thank you very much for coming on. This was a great conversation, very educational for both me, and I'm sure the audience will find it educational as well. Is there anything else you'd like to leave us with?
Thank you for inviting me, and thank you for putting up with me in scheduling this, because I remember we started talking about this at least 6 months ago, if not longer.
Right. Yeah.
And we kept delaying it, so I'm glad we finally got to do it. I hope your listeners get something useful out of it, and yeah.
Sure. I'm sure that they will, and I'm happy that we were able to figure it out, because I really wanted to get you on, and you got to stay persistent. So, what was that, sir?
Yes, definitely. I was giving you a thumbs up.
Oh, gotcha.
That's one of those things that you get used to doing things on Zoom, and sometimes the screen is full of people. So rather than talking, you do things like waves and thumbs up, and
right.
the new realities.
Yeah. Well, all right, everybody. Thank you so much for listening. I'm going to talk to you guys Monday. All right. Thank you again, sir.
Thank you very much. Talk to you soon, maybe.
Right.